Imagine one morning, the markets are open as usual. No crash news. No bank failures. No crowds withdrawing money. Only one thing is quietly changing. Money is starting to become more expensive, scarcer, and harder to access. In recent years, America has consistently been called resilient. The S&P 500 index is still at its peak. Unemployment hasn't exploded. Consumer spending hasn't plummeted. But behind that facade, the numbers are shifting in a different direction. Government borrowing costs are rising at an unprecedented rate. Household debt is reaching new highs. Delayed payments are starting to climb. And the financial system is operating with far greater leverage than it appears. Crisis doesn't come when everything has already collapsed. It comes when the pillars begin to weaken simultaneously and no one realizes the breaking point has already formed. What's noteworthy isn't a single number. It's how those numbers are linked together. Higher debt, higher interest rates, higher asset valuations while the margin of safety is increasingly thin. If 2008 was the housing market crash, then 2026 to 2027 could be a different story. A slow, protracted contraction of liquidity where the market, the budget, and confidence are all tested. And as confidence begins to crack, the adjustment is no longer partial but spreads throughout the entire system. Where are those signs appearing? We start where the pressure is building most heavily, the U.S. government balance sheet. The total federal debt has exceeded $34 trillion. But what's really catching analysts' attention isn't the total debt figure, it's the rate of increase in interest expenses. In a prolonged high-interest rate environment, each maturing bond issue is no longer refinanced at the low interest rates of the past. This means that the same amount of debt is being maintained at a much faster rate. A vicious cycle is beginning to form mechanically. Higher interest rates. Increased interest payment costs. Wider budget deficits. The government must issue more bonds. A larger supply of bonds puts pressure on yields. This is not a hypothetical scenario. It is happening quarter by quarter, issuance by issuance. For decades, U.S. Treasury bonds have been seen as the stable foundation of the global financial system. Their yields shape the cost of borrowing for home purchases, corporate interest rates, and even stock valuations. When yields rise, the entire system must adjust. It is noteworthy that, unlike in 2020, there is now less room for large-scale liquidity injections if the economy slows down. With interest costs becoming an increasingly significant part of the budget, each stimulus decision becomes more expensive. There's no explosion here. It's just increasing pressure, arithmetic progression. If the economy continues to grow steadily, the system can absorb this shock. But if growth slows while interest costs remain high, the imbalances will begin to become more apparent. And as fiscal space shrinks, every subsequent shock will have a more powerful impact. While the government faces a spiral of interest rates, another area is quietly sending warning signals, an area that directly reflects the health of the American middle class: household balance sheets. If public debt reflects fiscal health, then consumer credit reflects the true resilience of the economy. For years, American consumers were the primary engine of growth. Household spending accounted for a large portion of GDP. As long as people were shopping, the economy was functioning. But the recent picture reveals a subtle shift. Total household debt has reached new highs. Credit card debt has surged compared to pre-pandemic levels. Home loans and consumer loans are at their highest levels in years. The problem isn't just the size of the debt. The problem lies in the ability to repay debt in a high-interest rate environment. When interest rates rise, the minimum monthly payment increases. As the cost of living increases, the remaining income available to pay off debt becomes thinner. One indicator that is beginning to be closely monitored is the delinquency rate, especially in the auto loan and credit card sectors. These numbers aren't at crisis levels yet, but the trend is upward. That's how crises form. Not by an immediate collapse, but by graphs gradually sloping in the opposite direction. During periods of cheap money, consumers can easily roll over debt. But when high interest rates persist, that rollover slows down. If credit starts to tighten, not out of panic, but for risk management, consumerism will react immediately. Spending decreases. Business revenue decreases. Jobs are under pressure. Consumer confidence weakens. This effect doesn't usually happen simultaneously. It started in the low-income bracket, then gradually spread to the middle class. The key takeaway is, the stock market can continue to rise while household health is weakening. This creates a dangerous gap between the asset surface and the income base. When that gap is large enough, even a small shock like job losses or credit crunch will cause the system to react much faster than anticipated. While consumers are starting to feel pressure, the asset market is still sending a completely different signal, a signal so optimistic that many believe the risks are under control. It is at this point that the third pillar begins to emerge. While public debt balloons and consumers are starting to tire, the asset market tells a different story. The S&P 500 index remains in high territory. The valuations of many technology stocks are anchored above their historical averages. Money continues to flow strongly into index funds and passive products. The surface shows confidence. But the underlying structure is changing. A large proportion of the market's gains come from a group of large-cap stocks. When a few names lead the trend, the entire index can rise even if the rest of the market moves sideways. This creates the illusion that the economy is strong broadly. Simultaneously, high interest rates increase the cost of capital for businesses. Refinancing becomes more expensive. The commercial real estate market faces significant maturity pressure in 2026 to 2027. Herein lies a paradox. The stock market reflects optimistic future expectations. But the credit market reflects higher actual costs of capital. If growth is sustained, high valuations may be justified. But if corporate profits slow while interest rates remain high, the market will be forced to adjust expectations. And as asset markets adjust, the negative asset effect begins to emerge. Stock prices fall. Household net worth decreases. Spending becomes more cautious. Growth weakens further. It's worth noting that, unlike in 2000 or 2008, the current system is more tightly interconnected between capital markets, index funds, and derivatives. Volatility can amplify much faster than before. A 40% crash isn't needed to cause a crisis. Just a series of consecutive corrections in a thin liquidity environment is enough to shake confidence. And when confidence begins to waver, the reaction is no longer mathematical but psychological. It is at the intersection of data and psychology that the final pillar emerges. Up to this point, everything can still be explained by the numbers. Debt is high but not yet bankrupt. Credit is under pressure but not yet frozen. The market is overvalued but not yet collapsed. However, the financial system doesn't operate solely by numbers. It operates by belief. Belief that government bonds are always safe. Belief that the market will recover after each correction. Belief that the central bank always has the tools to intervene. As long as belief remains intact, liquidity will exist. As long as liquidity exists, crises are less likely to erupt. But in an environment of persistently high interest rates, policy space is no longer as wide as before. If growth slows while inflationary pressures haven't completely disappeared, policy choices become more difficult. Lowering interest rates too early could bring inflation back. Keeping interest rates high for too long could stifle growth. The market always precedes the economy. And the market reacts fastest when it senses that the safety cushion is thinning. Confidence doesn't collapse in a day. It erodes gradually through more volatile trading sessions than usual, through less favorable bond issuances than expected, through earnings reports that are no longer as exhilarating as before. At some point, the system is no longer threatened by a single number. It is threatened by the feeling that risk is increasing simultaneously in many places. As that feeling spreads, behavior changes. Businesses postpone investment. Consumers postpone major purchases. Investors go on the defensive. And it is this collective defensiveness that can create what everyone is trying to avoid, a widespread slowdown in growth. Modern economic crises rarely begin with a single shock. They begin when weak links simultaneously lose their connection. In 2026 to 2027, the United States doesn't necessarily face a collapse in the traditional sense. But if high debt, high capital costs, and weakening confidence all come together, the system will enter a cycle far more fragile than it appears. And when the world's largest economy becomes fragile, the rest of the world cannot stand idly by. And when markets fail to recognize that shift, they continue to behave as if everything is fine. Businesses still borrow. Investors still buy on corrections. Consumers still believe the difficult cycle will pass. But beneath the surface, the financial structure is adapting to a new reality. Higher capital costs, slower growth, and narrower policy space. In that environment, the system doesn't need a major shock to shake. Just one weaker than expected link, a less favorable bond issuance, a more difficult group of companies to refinance, or a sharper than normal correction in asset markets is enough to alter expectations. And when expectations change, behavior changes. Money flows out faster. Liquidity thins. Volatility intensifies. The danger doesn't lie in a specific number. It lies in the speed at which the system reacts when confidence fluctuates. If the indicators start lining up in the same direction, rising yields, tighter credit, market corrections, slowing consumption, then the contraction will no longer be silent. It will become visible. 2026 to 2027 may not be a time of explosive events, but rather a period shaping a new cycle where the U.S. economy is forced to rebalance under conditions where money is no longer cheap and confidence is no longer absolute. The story doesn't end there. What we are seeing is only the tip of the iceberg of the shifting risk structure. In subsequent analyses, we will delve into each crucial intersection point where a single variable changing can cause the entire system to react far more strongly than anticipated. Because in finance, the most dangerous thing is not the visible risk, but the risk that is forming even when everything seems normal.